Hold on, family, welcome back to the channel today. Talking about mortgage rates. Mortgage rates have tanked compared to how they were a couple months ago, with rates moving below 5.3% here in the last few days. We all know back in 2020, interest rates went down to historical lows due to COVID-19 and the response that the government made and the Federal Reserve with reducing interest rates. And they have edged up, shockingly over 6%, and which subsequently slowed down the real estate market. But I can remember with one of my properties, I got a VA loan, and we were locked in at 2.65 interest rate, which is crazy low compared to in the 80s where you had interest rates above 16-17%. And so relative to the times, but I wasn't born back in the 70s, and I wasn't an adult during those time frames, so I really don't have a whole lot of perspective for that. But mortgage rates are historically still kind of low, and I think there's going to be a psychological aspect to this with people getting comfortable with rates being in between the 5 to 7 range. I think they're going to normalize there. But first of all, we're going to talk a little bit about Freddie Mac and just them driving the 30-year fixed rate and tracking that interest rate data for over the last 30 years now. So Freddie Mac, they're the Federal Home Loan Mortgage Corporation, and they're publicly traded, government-sponsored enterprise headquartered in my neck of the woods, Tyson's Corner, in Northern Virginia. And they were created back in 1970 to expand the secondary market for mortgages in the United States. So they've been around for 30 years now, buying mortgages, and kind of a big player when it comes with interest rates and mortgages, 30-year mortgages that homeowners use, that loan product, in order to buy real estate. And so we'll share that link in the video if you want to do a little bit more to learn more about Freddie Mac and their business. But kind of really quick, just kind of walking through, if you go back to the 1970s when Freddie Mac was created, interest rates were kind of in the mid-7 range. And they moved up steadily, going into the mid-1970s, getting close to 10% before they kind of peaked around 11.2% in 1979. And, this was a high inflationary period, kind of where we are right now. A lot of people compare us to the 70s, but that was a high inflation area. Real estate went up in price tremendously during that decade. And right now, we're kind of seeing a lot of the same peaks, whereas real estate's been going up, inflation has been going up at the same time, and that's one of the things that we look at as the Fed tries to tame inflation and get the rates back down to around 2%. That we'll see how real estate fares. A lot of people are thinking that real estate we're gonna get back to around the 2019 time frame for its price evaluation, but it's gonna continue to trickle on up. And so 1980s, we went into a new era with rates where the average rate in the 1980s was 16.63%. This was for almost a whole decade. The average rate was around 16%. They kind of closed out the decade around 10%, but borrowing money across the board, credit cards, mortgages, you name it, whatever you need, personal loans, interest rates were high at the highest point that they've ever been since they've been tracked. And so that's kind of what we had in the 80s and the 90s. Rates started to dip below 7% during that time frame. The average mortgage rate in 1990 was still over 10% at 10.13% during that time frame. And then they would eventually, reduce and come down to around 6.5% in 1998. As you went into the 2000s going in, your rates were around 8%. In the mid 2000s, rates kind of went around 5%. I can remember buying my first property in 2006, and I had a 4.25% rate VA loan, and so the average rate probably was about 4.5% then. And but we had the housing crash that kicked off in 2008 that hit the housing market tremendously, and that's where we had somewhat lower rates. Prices were going up crazy, and there was a lot of buyers. There was not as much supply, that meet the demand, and so you had price appreciation that kind of got out of control. And a lot of loans that were being made to people who couldn't afford them, who couldn't pay for the houses, and when job losses and all that started happening, you had a large influx of foreclosures to come into the market. And so when we had the housing crash, as you kind of go into it, that time frame, if you can remember as an investor, let me know what were your thoughts during the 08, 09 crisis, when the market kind of started to crash and we saw it kind of bottom out over the next couple of years. Let me know, were you guys investing back then? Did you learn anything from that cycle? And that, I think that'll be something great to kind of carry forward, because wisdom is learning from other people's mistakes at the end of the day. And that's what we're all here to do. And we know we kind of came into 2010s. The average rate was around 4.69%. And we all know in 2020 that rates averaged at 3.7, but we had a time period after the pandemic where rates were down in the low 2% range, which is been just super crazy low, which now with super real rates drove a lot of demand, a lot of buyers in the market. There wasn't enough supply, and boom, you have crazy appreciation. And so now the Fed is raising rates to kind of slow down buyers, to slow down the market, whereas that now we can kind of get a good balance of supply and demand. And just for for you guys who don't know me, I'm Johnny Lynum. I know we've been in here a little bit. Make sure you hit the thumbs up button, subscribe to the channel, and hit the little bell so you can get notified when I drop new content. I'm all about sharing my real estate investing journey with buying BRRRRs, buy, renovate, rent, refinance, and repeat. Whether it's houses, duplexes. We just did a cash out refinance on our 18 unit that we had for about 2 years. We're buying more apartment buildings in Alabama, fixing and flipping in Panama City, Florida. And, just sharing my journey on how I built a side business, buying property, buying value add real estate, all while I'm still active duty military. Been doing that since 2015. Been in the military about 17 years now, and we'll continue to go. I started my coaching community after I wrote my book last year, Millionaire Real Estate Success Strategies. Make sure you download your copy for free in the link below, so you can read and kind of see my journey, and then some other real estate investors, a lot of them military actually, who've been successful in investing in real estate. But where we are right now, mortgage rates just recently plunged to 5.3% after hitting a recent high of over 6%. It freaked a lot of people out. The market, it kind of shocked the market with all the recession talk. Rates shot up. You still have Russia, Ukraine in the backdrop. You still have record high gas prices. And so people don't know what to expect to go with. And a lot of people now are like, hey, if this house is going to be $50,000 cheaper in 2 months, why should I buy now? People are backing out of contracts. So a lot of people on the sideline just waiting for things to kind of stabilize to see what's going to happen. And you really can't blame them. But as real estate investors, there is an opportunity for us to be able to provide value, to get assets at a discount, and still build generational wealth all along the way as the market is trending down. Because real estate is definitely cyclical, and it's going up and down, and you got to be able to know how to buy and have the right strategies with a long-term view of your investment. And so I think that's one of the things that we need to do and continue to look at as mortgage rates stabilize, and just be able to react once we get the information, to still remain flexible in our approach. But I think overall, one of the things that you're seeing coming up now, adjustable rate mortgages are more in play, because you can get a little better rate, and then it allows you the flexibility to get in the deal, and then you can potentially refinance in the future whenever rates kind of trend back down. You'll have that opportunity and to leverage that. And so that's one creative loan product that's out there that a lot of people are starting to leverage. And then also you can get into lower rates just by having that flexibility in the rate, but that's not for everybody. You need to make sure you know how you're leveraging the interest rate when you start getting into ARMs, those adjustable rate mortgages, to make sure that you're making the right decision, and you can refinance before it adjusts. And I put another video together that came out recently, just talking about 22. Is it a good time to buy a house? So make sure you check that video out as well too, and download the free book, Millionaire Real Estate Success Strategies. Have that link below for you. And just drop in the comments, kind of share back in 08, or if you were around in the 70s, 80s, 90s, just give. I would like to hear other people's perspective on interest rates with the higher rates in the past, and then just being able to still buy real estate during that time frame. Whereas that, I think as new investors, they really need to focus in on that you still can do deals in this environment and kind of learn some of those strategies. I think creative financing is going to be your friend definitely going forward. And so that's it for this video. Make sure that you hit the thumbs up button, comment below, subscribe to the channel.